course, we have talked about this over and over, that the Federal Reserve has two jobs or a dual mandate. One of them is to keep employment at a reasonable level, and second is to keep prices under control or inflation. Well, right now, the first job was a disaster, but in a good way. The fact that the jobs report came out and it surged way more than expected, Derek.
Right. We reported 528,000 new jobs in March, more than twice what the consensus estimate was. Wage growth continues to move up at 5.2% on a year-on-year basis. And the unemployment rate is now back to the pre-pandemic lows of 3.5%. So any thoughts that we're currently in a recessionary environment, I think we're squelched by this report.
We'll have to see what the Fed does with this information, but the unemployment rate is now back down to 3.5%. And the U.S. economy, Derek, is starting to look like 2019 with its labor market. However, in 2019, we didn't have this runaway inflation that we have now. So we do know that the Fed is in a precarious position, and it's highly likely they're going to raise rates again in September, but that's 6 weeks off.
Right. We're going to get two CPI reports between now and then, another labor report. In fact, the CPI will be reported on August 10th next week. The initial reaction to the number was for the stock market to sell off because it raised a possibility that potentially we could see another 75 basis point hike. Of course, that depends on the data, which Powell has said any number of times. But it does certainly push back the idea that the Fed may pivot, because there was some thought that if they tightened too much, the economy would slow dramatically and the Fed would have to reverse course in early 2023.
Yeah, and I think that pivot word is up for debate, right? So pivot means they'd actually have to turn around and start lowering rates. It could mean that they'll just take their foot off the brake. In other words, they won't have as many rate raises as expected. But there's this arbiter that I always look at, and it is the yield curve. When the 2-year yields are higher than the 10-year, that has been a harbinger for a recession for decades.
That is certainly one of them. There are any number of yield curves you can point to. The one that some say is the most successful predictor, though, is the 3-month Treasury bill versus the 10-year yield. And right now that still hasn't inverted. So that's a good sign, I think, for the future of the economy. The other thing I'd want to point out just about what was going on with the markets and the Fed is, we did hear from a lot of governors this week, and they were all very hawkish. They were talking about, the job was far from done. Bullard was saying that he thought they'd have to hike for longer. Yet the stock market shrugged it off. So it's looking like a possibility that perhaps we did see those lows in the middle of June, which is what you'd expect if we can skirt a recession in 2022.
And I'll tell you what, a 9% rally in July certainly gives credence to that argument, Derek. And there was also other good performance in that month as well.
Oh, absolutely. The NASDAQ actually is almost technically in a bull market. It's up 19% from its lows. Who would have believed that a month ago? And we did mention how people were very negatively positioned. Institutional managers had high level of cash, low allocation to equities. Sentiment was god-awful. A fear and greed index was in single digits. It's now back to neutral. So there has been a significant rebound, and it's a really important spot for the markets, both technically and fundamentally.